Good morning. It's Harvey Jackson. Well, I got the unexpected happened, and it's a good thing I didn't bet on Kearney not getting anything done, but on canola tariffs, and it probably was a good thing that Scott Moe was over there. Otherwise, he might have forgot about it. But canola tariffs on China, or to China, are expected to be lowered from that 85-ish% down to 15, and that's in response of some of the other deals that he's got made there with EVs as well. So you can see the EV and canola tariffs reset ties here. In the article, there's an initial trade deal to slash tariffs on electric vehicles and canola. Uh, Canada will allow 49,000 with, I did include some clips there so we can listen to it. Preferred tariff rate of 6.1%, which was the tariff rate before they increased it to 100%. And in response, they're going to reduce the canola tariff as well come March 15th. So it's going to go from their 84%, I said 85, but 84% down to 15. You can see it right here. And that's going to allow some of that movement in there. There's also some investment that China has already put into a lot of the industry anyway. And EV wind turbines. There's a whole pile of stuff that's kind of leveraged. So I think he's using that leverage maybe for the first time I've seen. And he talked about LNG, but not crude oil. So we'll have to see how that all plays out. If there's going to be more pressure for the actual crude oil when he starts talking to the province of Alberta. Just basically saying the same thing here. Here's the first clip, and I'm going to say it's kind of maybe a little bit dry. Maybe I'll just go to the next one.
Access their supply chains and increase local demand. And to help deliver the full potential of these partnerships and bring down costs for Canadians, Canada has agreed to allow up to 49,000 Chinese electric vehicles into the Canadian market, with the most favored nation tariff rate of 6.1%. This is a return to the levels that existed prior to recent trade frictions. But it's a return under an agreement that promises much more for Canadians. It's expected that within 3 years, this agreement will drive considerable Chinese investment in Canada's auto sector, creating good careers in Canada and accelerating our progress towards a net zero future and the auto industry of the future. With this agreement, it's also anticipated that within 5 years, more than 50% of these vehicles will be affordable EVs with an import price of less than $35,000. Over the next 15 years, Canada intends to double our energy grid through major investments in hydro, nuclear, solar, and wind power. That creates tremendous opportunities for Chinese partnerships in these investments, including in energy storage and offshore wind. On the other hand, Canada is developing our oil and natural gas reserves, one of the world's largest, to be the lowest risk, lowest cost, and lowest carbon. Last June, we exported our first LNG shipment to Asia, and we're scaling up quickly, making major investments in streamlining approvals. By 2030, Canada will produce 50 million tons of LNG each year, all of which will be destined for Asian markets. Au cours des semaines et des mois qui viennent, nous lançons tariff levels of 84%. Furthermore, Canada expects the Canadian companies today to announce that Canada and China have reached a preliminary but landmark trade agreement to remove trade barriers and reduce tariffs. By March the 1st, Canada expects that China will lower tariffs on Canadian canola seed to a combined rate of approximately 15%.
So I left the best to last there, I guess. But Yeah, so it does look pretty positive. So it, we might have to be looking at changing our positions there for now, because we got the news yesterday about the EPA as well, yeah, that they're going to have a ruling by or sometime in March, and that's positive for the soybean oil, and that gave us a little bit of lift yesterday. So our positions on canola are maybe getting squeezed here. So it might be time to just take positions off, or do some sort of protection there as well. But we'll have to look at that as well. So weather, getting some snow squalls and a fair bit of wind. So it doesn't look like a whole lot of moisture that we're going to get. But this is the accumulated wind that we're getting with it. It's not to say that it's quite high, but when you get fresh snow, it's definitely blowing snow out there, and some gusts that are pretty high as well. The weather in South America, this is just your weather anomalies, and there really isn't any real bad weather. It keeps on getting pushed out to the 2 week forecast, where you start to see some dryness, but that might accelerate some of the harvest as well. As there, I think last report was just under half, or just right around 0.5%. Quick look at the markets. So canola is up to 13.90 on the front month, 10.30 on the back month. Rapeseed up 3.75 as well. Soybean oil, good run yesterday, but basically flat here today at 53 cents. Palm oil is up 77 ringgit as well at 4,057. Crude oil up 78 cents a barrel, just shy of $60 a barrel at 59.86. Along with that, your New York Harbor diesel is gone up as well. Soybeans 10.56, 3 pennies up. Soy meal just a fraction of a dollar per short ton. Spring wheat is up close to 2 pennies, and your red winter and Chicago wheat are 3 to 4, so they're playing catch up from yesterday. Milling wheat is up a buck. Corn is up a penny and a quarter as well, and the Canadian dollar is up fractionally as well. Quick look at that. That's a nice little candle there. I still expect a reversal, but where is that reversal now that we've actually made it through that 645-ish area, where I had a alert for myself just to reevaluate, and the 645 was right on this other 100-day moving average. New crop, nice leg up there as well. So definitely have to look at rewarding this rally for sure for new crop here. That's European rapeseed. And European rapeseed now falling apart now that the North America canola or Canadian canola is taking off. European rapeseed is not rallying as much, and I just did a farther back view here, so you got $107 differential price in Canadian dollars. This is the margin. Had this question again yesterday, so I thought I would just show it. So, and what it does is give you relative for different timelines. So, and how it's pricing is based off of soybean oil and soybean meal as a factor. So you just have to keep that as a note there as well. Soybean oil futures, nice leg up here, and it looks like we're going to try to break through this choppy sideways trend, because all of the moving averages are in this range as well here. Soybeans, really a nothing story there. Same thing with the crude palm oil. This leg up for crude, looks like it's going to retrace back into this below the $60 a barrel area. We don't often look at this, but this is your West Texas price differential. So you're $59, and that's that pull down as well. But you basically went from 49 to let's call it 46.75. So there's always this price differential between what the Americans are buying the Canadian heavy crude, because they're primary only buyer there of that product. New York Harbor freight or New York Harbor diesel pulled back a little wee bit here, but it's green today. Canadian dollar, basically trading sideways right at that 200-day moving average as support. It seems it doesn't want to go below it. When you look at the U.S. dollar index, it's on a run. So is your gold. So is your silver. And your silver didn't quite get to the $100, but it's at 91. I think it was when I had a look at it there. Red Spring at the bottom of this channel. Same thing with your Kansas and your Chicago, and even your milling wheat. And it's going to be hard to make this market move if you've got the corn complex at a bottom as well. Tough to make this market move up here. And that's all I have for you today.